The Bank of Canada is anticipated to slash interest rates by another 50 basis points BPS in December, marking the second consecutive rate cut in as many months. This move is expected to bring the overnight lending rate down to 4.75%, further easing the monetary policy stance. The decision to cut rates is driven by the bank's concerns over the slowing economy and the need to support economic growth. The Canadian economy has been facing headwinds in recent months, including a decline in housing market activity, sluggish business investment, and a slowdown in global trade. With inflation currently running below the bank's 2% target, there is room for further monetary policy easing. The rate cut is expected to provide a boost to the economy by reducing borrowing costs for households and businesses and by supporting the exchange rate. The Bank of Canada's decision to cut rates is also influenced by the actions of other major central banks, including the U.S. Federal Reserve. The Fed has already cut rates 3 times this year, and the European Central Bank has also implemented a series of monetary policy easing measures. Overall, the expected rate cut by the Bank of Canada is a sign that the bank is taking proactive steps to support the economy and ensure that inflation returns to its target. The move is expected to have a positive impact on the economy and will likely be welcomed by households and businesses across Canada. Impact on the economy. The rate cut is expected to reduce borrowing costs for households and businesses, supporting consumption and investment. The lower interest rate environment is expected to support the housing market, which has been slowing in recent months. The rate cut is also expected to support the exchange rate, making Canadian exports more competitive in the global market. The move is expected to have a positive impact on economic growth, supporting the creation of jobs and income, risks and uncertainties. The Bank of Canada's decision to cut rates is subject to risks and uncertainties, including the potential for lower oil prices, a slowdown in global trade, and a decline in business confidence. The rate cut may also lead to an increase in household debt, as lower interest rates may encourage households to take on more debt. The Bank of Canada will need to carefully monitor the impact of the rate cut on the economy and inflation, and be prepared to adjust its monetary policy stance as needed.